Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. This past week, the Federal Reserve raised interest rates 0.75% in their continuing effort to fight inflation. We now have the federal funds rate, government bonds, and mortgage rates at the highest level we've seen in about 15 years, all in response to inflation. Our first graphic we have today is going to show you the 10 largest increases in the federal funds rate over the last 75 years. As you can see by the highlighted column, that this is already the 6th largest increase. And if you look at the forecast over the next several months, this is likely to be the 3rd or 4th largest increase in the Fed fund rates in the last 75 years. Clearly, the Fed is intent on fighting inflation. Our next graphic shows why they are so intent on fighting inflation. As you can see by this one, a year ago, inflation was at just over 5%, which at that time was a multi-decade high. It reached over 9% this summer of 2022, which is actually a 40-year high and has only started to modestly come down. And the main reason it has started to come down is that oil prices have fallen from the highs seen at the time of the Russian invasion of Ukraine. We really need to see other components start to fall to see inflation make a dramatic drop. And so what we've done is take a look at the next chart, and our last graphic really shows what inflation might look like over the next year based on different rates of inflation on a month-over-month basis. What we've done is framed in what would happen if inflation was 0.3% or about 3.5% a year. How fast would inflation fall? And you can see by the spring of 2023, inflation's down to about 4%. And what's important about that is that the Federal Reserve rate would be probably 4 or 4.25%. And historically, when those two numbers align, the Federal Reserve has stopped raising interest rates. So why is that important? There's an adage in the investment world that says, don't fight the Fed. If interest rates are rising because the Federal Reserve is raising interest rates, you tend to be more cautious. Just like if they're lowering rates, you want to be more aggressive. Today, we need to be more cautious, and we've done that for our clients. We've had more cash. We have assets with less volatility that we can sell if we need to fund additional lifestyle needs. And that also allows our clients to work through what has been a very difficult equity market in 2022. Regardless of what is happening in the market and how the Federal Reserve is managing their balance sheet and what they're doing with interest rates, we continue to make adjustments to portfolios to help our clients reach their long-term goals. As always, thank you for the opportunity to serve you and your family, and have a great day.